Call it to order, please. Can I get a roll call?
And thank you all for being. Here. Trustee Rubin.
Here.
Trustee Hallwax.
Here.
Trustee Mealopoulos.
First item on our agenda is public comments. If anyone's interested, I've got 7 minutes of material to read.
No, thank you.
Hearing none, seeing none. Okay, we'll move on. Consideration of the minutes, next item on the agenda. Did anyone have any comments or questions? Otherwise, may I please get a motion to approve? Motion to approve the minutes. All right, all those in favor? Aye. How about you guys? All right.
That's a unanimous.
Excellent. We're off to a great start. And that brings us to our review of the monthly financials, please, Nikki.
We have a big agenda tonight, so.
And thank you again to the guests in particular for joining us in person and via Zoom.
I've done that.
Yes. So I will be going through the April treasurer's report rather quickly, but please stop me if you have any questions. Because we also have the CIP update. Obviously, we have guests to talk about the portfolio, and then we'll be talking about the purchasing policy and the local grocery tax tonight too. So bigger agenda than normal. Okay, so jumping into the April financial report. Our property taxes are running higher than last year by about 367,000, about 50% of what we budgeted for the year, right on target of what we expected. Although we did receive over $500,000 in property tax revenue in April, which was not expected. We did not have that budgeted for the year, so it was a nice, or for that month. So it was a nice bonus. I don't know if the county's running late or if folks are protesting their taxes, but it's a good news story nonetheless. Sales taxes appear to be rebounding. They're more than this time last year and monthly budget. This is January sales, so we're running about 35% of budget. It's too early to say that this is for sure tariff related. Because it's too early in the year. Phil and I were talking about this earlier today, wondering if this is folks that are panic buying.
We bought a couple more cars earlier than they otherwise.
Yes, exactly. So it's too early to see if that's actually happening because of the 3-month delay, but that's something we'll keep an eye on. Nonetheless, this was a strong month from a revenue standpoint. Our income tax, building permits, telecom tax, cable franchise fees, parking fees, garbage service fees, sewer charges all blew the budgetary targets out of the water. And they're all higher than this time last year. So all good trends to be in a good place in May.
Part of it's increases on all those too, right?
I'm sorry.
We've increased fees on all those, they're gonna be
We
higher
have.
naturally.
Yep.
So
that's
like,
part
if we
of
were
it.
to take last year's fee level, it might be flat.
And even it out, yeah. It's possible. So that's a good point. Although telecom didn't change, income tax did not change, and cable didn't change. So some of them are probably related to the increases. On the expenditure side, we're within budgetary expectations, about 30% of budget, so slightly less than our budgetary projections, but we are running higher than last year, which is what we expected. This was a strong month for the water fund. Here, the revenue changes are related to the fee increases that we've made. Volumetric revenue is running at 20% of budget, $42,000 higher than last year. And fixed charge revenue is running right on target, about $8,000 higher than last year. Our expenditures are higher than last year. They're up about $285,000. The expenditures in the water main project are starting to hit the fund. So you'll see on Thursday night's check register, a rather large payment in the first installment of the 2025 water main project. But nothing to be alarmed because we budgeted for that, so we're anticipating that happening. And I'll turn it over to Stella, who is the most exciting news of the night, probably.
Well, first we'll talk about April, which I'm happy to say we did exceed our budgeted revenues. It wasn't a great month. And because it wasn't a great month, we also saved 50% on our part-time employee budget in the pro shop and 20% in the greenskeepers. So when we have bad weather, people stay home and we're able to manage it more in-house, and that's how we save our money early on. Most exciting, Clubhouse is gone, the witch is dead. And really quite relieved that the building is down. The job that they're doing out there is outstanding. Put some information together for the Friday report. But majority of that building is going to be reused, recycled, or repurposed. They picked up 14 pallets of bricks today. There's
Good.
500 bricks in a pallet. So it's a significant amount of reuse there. All of the metal and all the copper is getting recycled. And then it further goes to a sorting station where it gets picked through by hand. So it's a really good way that they're taking down that building, and it's especially the concrete, so much concrete, it's all gonna be reused. Super happy to see that. And we're moving forward. They're working hard, just removing the debris right now. And we hope to have the site fairly clear by groundbreaking on Monday.
Excellent. Thank you.
Bird update.
Oh, wow. Funny you should mention it. We did have our bird walk today. And we saw an endangered species. Our guide was going crazy. The golden winged warbler. Very, very rare, I guess, for this part of the world. And they're on the endangered species list. So the golf course. Where was it? Right by the second tee. And the trees back there. So all the birds that are migrating, we had
So we take that
1.7 million birds migrate through Chicago last night. And they need a place to rest and eat. And the golf courses are their main source of food. So another reason golf courses are great. So we had a ton of birds there. It was a very exciting event. We identified over 26 different species in a very small area. Thanks, Nikki.
Thanks, Phil. It's hard to follow. What's more exciting than birds? Debt service. There we go. Moving to the rest of our funds. Our debt service payments are also on Thursday night agenda, so you'll see that on the check register. We have just over $500,000 that'll be payable to Zions Bank, who is our paying agent on all of our outstanding bonds. And again, this is interest only, so our principal payments will be made in December along with the second installment of interest. And then our capital projects fund is starting to pick up. We're seeing early expenditures on the golf club project starting to hit the general ledger. Just a reminder to the committee, I'm sure you all remember this, but the golf club project fund expenditures are all going to be hitting the capital fund, not the golf fund. So we've centralized all of that into the capital projects fund because it is a bond funded project. Closer to the end of the year, closer to the end of the golf fund project, there will also be a transfer in from the golf club fund once we know how much we need from reserves. So we'll monitor that throughout the year. And then the motor fuel tax fund, you probably saw in the Friday report, the crosswalk improvements have been installed, or at least the first phase of them. So we have about an $88,000 expenditure in the motor fuel tax fund, which is actually pretty big for that fund. Doesn't see a lot of activity. On the personnel side of things, same story as we've been saying for the last 5 months. Our full-time salaries and pension contributions have increased as planned, with those being the two largest drivers. We are caught up year over year in terms of numbers of payrolls, so I don't have to give you that caveat anymore. But we do also have that AFSCME retroactive pay that's just going to drive that number up a little bit higher this year as we compare it to last year's. Retro pay for what we got. It was the retro pay that the board approved it in February. So it was really just January. Yes. And then. Yes, January and half of a month of February is retroactive. So, just an anomaly. Yeah. Moving into the projections, obviously a strong revenue performance month for us, and just a good position to be in 5 months of the year. The general fund's already running about $495,000 over budget projections. And the water fund is in a similar fate. If everything goes as planned, we would end the year with 134,000 more in revenue than what we budgeted. When I add expenditures into that equation, the general fund's still on track to draw down about 4.2 million. Again, that can change depending on where we go between now and December. We had a budgeted drawdown of 4.8 in the general fund, so pretty close. And then the water fund is right on target, about 3 million planned drawdown. At the end of the month, our general fund reserves are sitting at 18.4 million, which is about 60% of expenditures, and the water fund is 6.1, which is about 77%. I am caveating, these are unaudited technically. We're at pretty close to final numbers. Next month, we will have the auditors and the actuaries coming before you, so that'll be an exciting meeting too to look forward to. And then the last item on inflationary and economic impacts. Really not much has changed from our prior reports. Our commodities are still running lower than last year, pretty much right on target with what we had budgeted. Contractual services are slightly higher, but still underneath budgetary projections. We have had several vendors reach out with, scare tactic is a strong word, strong warnings maybe, with the potential impacts of tariffs. We have yet to have to really pay anything increase because of that. But primarily what we're hearing from our electronics focused vendors or tech vendors. So still a little bit early to see how that will shake out, but it is something we're watching. Any questions on financials? Okay. So we're going to switch gears a little bit on you here to the CIP report. I'm going to hand this over to Monica. So coming before you, the village board is there's no approvals for purchases under contracts with the CIP. The reason for that, we have a couple changes in the schedule, which I'll go over. The first one is the bridge maintenance, construction, engineering for the Sylvan Road Bridge. We thought that scope would be ready to present in May. It'll get pushed back to June, so both Scott and Sylvan scope of work will be presented in June. I think I mentioned this last month, but these spot repairs for Scott Avenue are going to be combined with the construction work that is proposed for next year. So that I have this new symbol on our tracking spreadsheet with the X. Xed out that project, that line item we will not track, and it'll be included in the work for next year. We've also updated the timeline on the second floor renovations. So that's been pushed back a couple of months, just through various small delays, but more realistically, we'll be seeing completion in October with final books out.
Any material impact on cost?
Don't believe we've been seeing any so far. I think, like Nikki said, potentially with the technology purchases, but nothing's materialized yet.
Okay.
The next one is a project we've been talking a lot about is the residential sidewalk repairs and pedestrian crossing improvements. They've told us they're ready to mobilize. We just need to get that kickoff meeting. Hopefully it will be scheduled this week and they'll start working in May. So that just bumped up the schedule sooner than we were anticipating, which is good news. And the last one is the IT network improvements, installation of air fiber network. This one also got that new symbol of the X. We've deprioritized it for this year. The funds for that will be shifted to investing into the SCADA network. Yeah, so. Any questions? All right.
Thank you.
Brian, you're on the full screen.
There we go. That's better.
I can just provide a
All right.
hold on one second, Brian. I'm gonna provide a brief update. As this group will recall, PMA's been monitoring and managing our investment portfolio since 2019. And we added cash management to that with the local government investment pool known as iPrime in 2020. As a reminder, when we invested with PMA originally, we put approximately $5 million in the portfolio. The goal of this portfolio is to preserve that cash. It is idle cash that's sitting in a number of our funds that has been earmarked for expenditures that are longer term. So our primary goal is not to lose that money, but earn interest where we can. So we have historically been governed by 3 conservative regulations from the state of Illinois as a home rule unit. Brian will talk about some options that we might want to consider now that we are home rule. But it's, definitely not a pension fund, so we won't be investing in any banks or wineries or anything. Alternative investments. So joining us today is Brian Hexel from PMA. Also in the room, we have Sarah Schnorr and Ben Carney from iPrime. So we'll be providing some updates on our local government investment pool. And then we'll also be talking about everyone's favorite topic, arbitrage. Yes. So I was Brian kicking it off first.
I can just kick it off
Okay,
real quick.
perfect.
So
I'm gonna make one last second. Can I make one other suggestion before we get started? To Nikki's point, when you look on like page 4 of today's agenda, this looks like something that you just is in your system, it cranks out automatically. Can we maybe add something that has the purpose of these assets to Nikki's point?
Sure.
So when we look at this and well, why isn't it making 8%? Why isn't it invested? So I would think there can be a standard page that you make one time, never have to redo it again. It'll be permanently in our kind of like whatever module template we have. But just to reiterate to Nikki's point, what is the purpose of these assets so that the next board that comes in here isn't saying, well, why is it only invested in short-term government securities? That might make.
like I was kind of doing.
There you go.
Beginning.
So
Sure.
again, I do what you do. So sometimes it just makes life easier.
Sure.
And is it the answer? He wants to look at a paper, whether you know much about finances or not, seen the volatility in the marketplace.
I mean, to be fair, we
Downside.
we could have an asset pool that could take lots of risk, and this is not that. And then let's make it easier. Georgia makes a point.
No, I think that's a great point.
But again, if it's easy enough, just to hopefully you don't have to touch it again.
Sure, definitely. And, I think Nikki provided a great overview of kind of the purpose of these funds as well as the relationship and just a little bit of background for all of you who may not be totally familiar with the team and PMA. So I'm Sarah Schnorr, and I'm actually here pitching for Lisa Nusko, who is about 2 weeks out from having her second child. So we decided to let her stay home today. But I've been with PMA since 2006, had primarily been working with Wisconsin municipalities, and I'll be working with our iPrime clients throughout the summer and while Lisa's on maternity leave, but have worked with numerous clients who have long-term portfolios with our investment advisory team, as well as shorter term portfolios with our local government investment pools. I'll allow Brian to introduce himself just a second, but Ben, do you want to introduce yourself as well and can talk about what your role is with the village?
So my official title is the Institutional Investment Specialist for iPrime. You can also just call me the day-to-day contact for the village's iPrime account. I've been with PMA a little over 2.5 years now, right after graduating from NIU with my bachelor's in finance.
And the last person on that team is Steve Adams. He helps out with our downstate clients. He lives just outside of St. Louis. To the next slide, just a quick PMA overview. So you'll see that there's a couple of different companies that are serving you today: PMA Financial Network, PMA Asset Management, and PMA Securities. Those are 3 separate companies under common ownership. And primarily 3 separate companies for regulatory purposes. So we've got the investment advisor as well as the broker dealer, and PMA Financial, which provides the administrative support to our local government investment pools. We work almost exclusively with public funds. So, our, our world in the investment universe is a little bit smaller than some of our asset manager counterparts because we're focused on just those types of investments that are allowable under state statute, focusing, of course, on safety, liquidity, and yield, and preserving those funds for our public entity clients. We have just about 146 billion in assets under administration and 122 billion as of last December in assets under management. So we've grown substantially over the 40 years that we've been in existence. And we were started by an Illinois Community College CFO out in our offices are in Naperville. So we're locally homegrown. You've seen us along the way throughout her career as well. So today as we've talked about, we want to talk about that long-term investment portfolio. Brian will give that overview, talk a little bit about the funds in iPrime, and of course, take a look at those bond proceeds accounts and the status of those related to arbitrage rebate payments that may be needed. So Brian, you want to get started on the investment process?
Absolutely. And good to see you all. I just have interesting luck with this meeting. It was the turkeys one time and now I kind of got double booked here tonight. So I appreciate everybody's patience. This slide, what we're really trying to emphasize here is that at PMA, we have a process that we believe strongly in. And we've certainly seen a lot of volatility in the markets here over the last couple of months. And, the good thing about this process that we have in place is whether it's calm markets, volatile markets, unusual, it always starts with research. We do the work every single day on every security in the portfolio. I'm not going to go around this whole circle, but at the end, step 5 there is about measuring those results. We share those with our clients in a very transparent way. And that measurement informs us as well and leads right back into our research. So, jumping ahead, I can tell you that performance looks very good here over the past year and over the past quarter for that matter. Feel very good about the Villages portfolio. A couple of thoughts on what's going on in the markets. The Fed, as probably most of you in the room are aware, meet 8 times a year. They just met last week. They did not change interest rates. In their March meeting, they provide an update on forecasts in terms of where they expect the Fed funds rate to be and also economic forecasts. So in March, that was prior to the April 2nd tariff announcement. And you can see that the Fed was already starting to worry about GDP growth slowing a little bit, a small tick up in unemployment, and a little bit higher inflation. Certainly what we heard from the Fed last week was those concerns being amplified. And then as the news cycle continues to move here over the weekend, obviously a pretty big relief rally here today with some optimistic news on China trade. So it's a quickly evolving picture. I think what we can continue to say with some level of certainty is that the next move from the Fed will likely be down. So those very short-term rates, will probably end the year a little bit lower than we're at now. This chart at the top shows, around anywhere between 2 and 4 rate cuts is what's sort of expected here by the end of this calendar year or looking out 12 months. And that pretty well holds true here today. It's been moving around, but, expectations still are that the economy does slow a little bit and the Fed cuts rates. Moving on to the next slide. Maybe a little more directly related to the portfolio here. During the first quarter, we definitely saw some softening in the economy, not so much in the hard data. That GDP number didn't come out until April. Unemployment was remaining good. Inflation was generally trending down. So the hard data was good, but it was the soft data, consumer confidence, business sentiment was softer. We saw it soften in February and then again in March. And, at the same time, again, with uncertainty rising, you saw a pretty significant sell-off in the stock market, and meanwhile, bonds rallied. So what we're showing in this top chart is fairly significant decrease in yields for 3-year treasuries, 5-year treasuries, 10-year treasuries. And with that decrease in yields, bond prices moved up. So we'll certainly see here as we move into the performance in a little bit that returns have been, quite strong with the move down in interest rates. So one more slide on the markets and our outlook specifically here. Our thought is for the very near term, the Fed does remain on hold. As I mentioned a moment ago, we do think the next move is down, but they're waiting for that hard data to come through. The GDP number, we all kind of know what was happening there. That was a lot of imports, but it's really about watching what does unemployment do and how much basically does inflation move up. We will get CPI tomorrow. I wouldn't expect a lot of that tariff to be moving through into the April report, but that's something that certainly the markets will be looking closely at. We definitely think this market volatility remains high. The Fed is waiting on the data, and thus the markets are waiting on this data. So every piece of information that comes out, obviously all new policy guidance, budget information that's coming out, all going to be moving markets here. Want to emphasize to everybody, volatility is not a bad word. It's two directional. And, our goal as investment managers is to buy low and sell high. So when we think that markets are getting out of whack one way or the other, it may be a good opportunity, on the margin to do a little bit of selling and a little bit of buying. I think one good thing about the market right now is corporate balance sheets are in really strong health. Debt levels are low. Profit margins are strong. That, even if we see some economic slowdown here, we think that, that bears well for employees, basically, that there's probably less of a chance that companies need to start making cuts that could really lead to a deeper type recessionary environment. And we are not calling for a recession. And part of that is the consumer has remained so resilient. Higher inflation, higher interest rates, the consumer has hung in there. Returns, certainly uncertain here. Again, Fed probably cutting, moving interest rates a little lower. Overall, that should be good for bond markets, good for portfolios like this. But, sharp movements one way or the other in interest rates still are, at higher than usual levels in terms of that volatility. So I'll pause there just for a moment. Any questions on the markets, the economy before we switch to the portfolio? All right, we'll move on to was there a question?
Good.
No question.
We did want to address the Public Funds Investment Act. This is what Nikki alluded to in her opening comments. What is currently allowed by state statute. A couple of these first bullet points could actually be the beginnings of what was alluded to in terms of describing what the purpose of these funds are. So we'll certainly work on that slide.
Maybe
But,
just what's not allowed to. So maybe just add to this. What's not.
Sure. So, just real quickly, what is allowed: treasuries, government agencies, that's Fannie Mae, Freddie Mac, agency mortgage-backed securities, municipal securities. We would buy taxable municipal securities. Tax exempt wouldn't be something that probably makes sense. And then corporates rated A or better. So what's not allowed? Things like stocks, not allowed. What you might call junk bonds or high yield bonds. So bonds rated below BBB would not be allowed. So your derivatives not allowed. These would be your higher risk asset classes. So as a home rule, a few things come to mind for us in terms of what could be added here. Asset-backed securities. So these are securities generally backed by credit card loans, auto loans. There's a variety of other types of asset backs, but those are the two big categories. We definitely like prime issued AAA asset backs. Those can offer some nice incremental yield. On the corporate front, under statute, there was actually recently a change increasing the maximum maturity from 3 years to 10. So with a 1 to 5 year portfolio, fully utilizing that 5 year So increasing that would certainly be helpful. The 33% limit on corporates is something that I think we could increase that limit or remove it altogether. You know, again, recognizing that this is only a portion of the portfolio. So we're actually fairly conservative in this 33%. In theory, this could be 33% of all assets held by the village. So there's a few things we could do here, but I do want to emphasize as you think about high quality fixed income market, you know, maybe we could pick up 10 to 20 basis points on some of these. So that's 0.1 to 0.2%. And that would only be maybe 20% of the portfolio. So now you're kind of taking 20% of 20%. You know, we're talking about maybe 4 or 5 basis points of incremental yield. So, you know, the market is what the market is. I certainly wouldn't, you know, suggest thinking about stocks. I don't think getting into high yield bonds is something that you know, the village would want to contemplate. So we could certainly put our heads together, think about what would make sense here. But you know, I do want to emphasize that we're, you know, pretty broadly utilizing what's available in the you know, the high quality fixed income market. But you know, again, on the margin, there is some room to be additive. I mean, any immediate thoughts from the committee on, you know, areas that may be of interest to invest?
No, the numbers are great. We'll take their guidance.
Absolutely.
If there's any, you know, if there's any additional risk that you think is rewarded, we should listen.
Yeah, I mean, like I said, there's a few areas that I think we could definitely look at. It's, you know, we're not going to see equity-like returns. It's just not the nature of the portfolio. But, you know, if we could add, you know, maybe aggressively, you know, 5 to 10 basis points of yield year in and year out, that does add up to real income over time. So we will certainly take a good close look at that with the home rule status now. And again, currently we're utilizing fully everything that's allowable under statute, you know, short of being a home rule entity. On this portfolio, highlighting the
Brian,
Yes.
one question.
Yep.
I think maybe it's in here in the presentation, sorry if I missed it. Is there a slide or data that talks more in dollars than just percents? Like, what have we gained since the beginning? Let's see.
I do not-
What did
I
we-
do not- I don't have the dollars in front of me right now. But you know, I want to say this portfolio has, see, can we mind advancing the slide 1 or 2 here, slides forward? I just don't want to miss, one more. There we go. So back 1. Oh yeah, there's a total here also. So
And if Margaret goes to 18,
October 2019.
have your market value there.
Yeah. So I
Um,
can't remember what was transferred into this account. It may have been an even
Really,
5
It was 5
million, but
even.
It was 5
Yeah.
even.
We're sitting at a little over 5.5.
Yep.
5.9, 5.7.
so clearly that was in a near zero interest rate environment when we got started in 2019. So interest rates moved up, bonds moved down, but you know, we've now grown the portfolio about 10% from 5 million to 5.5 million. So it's been, you know,
Yeah,
it's not been the best 5 years for
Yeah.
bonds.
No, it's
but
kind
better
of
than
talking
that.
numbers a little bit.
But all right, so
Yeah,
if
it's a great-
he's saying, well, let's see, maybe we want to take on more risk and maybe you'll get 4 more bips, you know, basis points. Okay, well, that's $22,000 in a year if you successfully capture on our portfolio, 22,000. I mean, so it's sort of like, how much more risk do you want to take
I
for?
understand. Yeah,
That's a really important concept, I think,
Right.
as we're thinking about investment policy adjustments. You know, what is that risk versus reward scale and what do you feel most comfortable with?
I think from what it sounds like, I mean, I certainly have liked what you all have been doing for us, and I think, yeah, Joe agrees, so it's.
I'm good, I just
Yeah.
sometimes need to see it more in dollar amounts
Right,
and percents.
Right. But if you've got good ideas, we'd like to hear about them.
Yeah.
It's not like we're first to.
And you could also like ask Clearwater, is there a way to say like, calendar year 1/1, our dollars were X. And
I
on
think it would just help.
March
show our
31,
residents.
2025, our dollars are now Y. You know what I mean? Like,
It would just help clarify, I think, just for residents who are watching.
we run that in Paris where it's just, they call it their financial reconciliation module, and it's for people like Georgia that say, show me dollars. And But with it, it will also show you what you've taken out and what you've contributed. So it's trying to give people the picture, okay, in hard dollars, what does this look like? As opposed to basis points, because to your point, sometimes, when you say,
Yes,
okay, we're gonna
me,
take on
everybody
some
else.
risk to make the village only $22,000. Yeah,
Yeah. Right. Another opportunity, but in this very volatile environment, other opportunities may present themselves and we'd like to hear about.
Sure. No.
Absolutely. And I want to just emphasize for everyone, anything that we would offer up would be of high quality and what we believe is appropriate for a municipality. And honestly, something that we're investing for someone else. So I mentioned asset-backed securities. Those are allowable in Wisconsin under statute. So we buy them for our Wisconsin clients all the time. So I won't belabor the point, but there's some opportunities there that we think are high quality and just areas that Illinois statutes sort of not keying in on, and we could open that up for the village. But at your discretion and your ultimate approval on it. So we will come back to you with those ideas in a more formal presentation. I don't have a lot more to add on this slide. I feel like we kind of talked about it here. High quality portfolio, diversified across sectors. You kind of get a sense here of what the yields look like across the different sectors, the time to maturity. Bottom line here is we have a nice yield advantage over our benchmark. That is the idea of this portfolio. A treasury agency portfolio, that's essentially, what a very basic portfolio would look like is professional managers who are looking across these sectors, the ability to pick up this extra 16 basis points. And I would say over time, it's usually more like 20 to 30 basis points. Spreads are fairly tight right now. That's a nice income advantage and, is what really helps ultimately generate those higher returns that I'll share here in a moment. So on the next slide, duration, 1 to 5 year portfolio in line with the benchmark. I don't have a whole lot to add here. Can move on to the next. Do want to emphasize that we are constantly making adjustments to the portfolio. We're not a hedge fund. We're not buying and selling the whole portfolio every day. By and large, we're buy and hold investors, but we definitely do sell securities from time to time. And, the latest trend that you're going to see on here on the right, probably 4 or 5 columns, is an increase in that gray bar, and that's U.S. Treasury securities. And what we found here lately is that credit spreads are so tight, sort of to the point that was on the table here, the risk reward just not that great to pick up, 10 or 15 basis points over treasuries. We may as well just buy the treasury, and when spreads widen out, 1, you don't get the downward impact of that spread widening, and 2, you can easily sell those treasury securities and move into another sector. So, we've got the nice allocation to various sectors, but we have been growing that treasury allocation, really just waiting on additional opportunities here that the market, surely will bring us here in time. Going on to the next slide. That does get us to our returns. And you can see year to date, we're off to a pretty strong start for bond returns to be at 2% through the first 3 months of the year. That's on pace for 8% returns. I certainly don't expect us to generate 8% in the fixed income market here this year, but we are off to a good start. Over the last 12 months ending March 30th, we're up over 5.5%. You can see all of these returns consistently exceeding our benchmark. Since inception, again, we started off in a very low interest rate environment, but good to see here recently bond market behaving more the way that we would like it to be behaving and generating some of the nicer income for the village that, we know that as long as we stick with this plan, we're going to be able to generate for Glencoe. I might have one more slide. Oh yeah, so the next 3 slides just go through the holdings. I think that was something that was requested, so you can get that detail on every single holding in the portfolio. And again, each of these holdings thoroughly researched, not only prior to being placed into the portfolio, but on an ongoing basis, real time. Our research analysts are following these names, and I think you'll see, especially as you get into the corporates here, these are by and large very much so household names, from American Express at the top, right on down to United Health. So that does wrap up.
I do
Oh,
want to
so
note,
this was the
Brian,
summary.
yeah, on page 19, that's where we laid out those additional investment considerations. So if anybody thinks about it and has some, ideas of something that you'd like to see in the policy, please let Nikki know. We'll kind of think about it on our end, and we'll come back with that formal update to the policy.
Well, if it's allowed, why would we just add it to the policy? And what's our downside? We don't have to do anything, but we just we add what's allowed with home rule to our policy under allowable securities. Even though we don't have any kind of target to it, I don't see what the downside is. That way, if they come back and say, hey, we really love some spreads and triple Bs widened out, then we have to go and change the policy, then they can go do something, as opposed to just changing it now. And then if they have an opportunity,
I agree with that. The one thing I would say though is extending out the maturities past 5 years. What do you think about that?
because I think is the rule so it's not quite clear. It's the average duration has to be 3. Because if you look on page 13, we have 3 and 5 or 4 and 11.6% of the holdings are in 4 to 5 year maturity. So is the rule for municipalities 3 years is the average
Oh,
maturity?
There is no rule on the maturity. We've assigned a benchmark of 1 to 5 years for this portfolio. I would say maybe 70-80% of our public clients choose that 1 to 5. We do have 20 to 30%, maybe pushing a third, quarter to a third, that utilize a 1 to 10 year. And that really just comes down to, the duration of a 1 to 5 year is about 2.5 years. As you move to the 1 to 10 year, it only moves out to a little above 3.5. So it's only about a year difference in duration, but you do get some of those maturities going out 10 years. With the reserve size here of 5.5 million, I mean, my gut would be to stay with the 1 to 5 year portfolio here, but you certainly could invest to 10 years.
I think 1 to 5. I'm sorry, go ahead.
Just to say, part of the rationale originally with the 1 to 5 year term was that this was kind of dipping our toe in investing some of our cash with a professional manager for the first time. And we were thinking our long-term forecast goes out about 5 years. This is what we were comfortable at the time. So we certainly could revisit that, but that was kind of the history as to why we picked that.
Well, also in the sense of, the rainy day fund, whatever term you want to use. If you're sitting there with much longer durations, you're taking more risk than at the time you need the money.
Mhm.
It's great if you're just letting it sit there and you get your return. But if it turns out you need the money and the market has moved, the value that you'll get for that bond is dropped. What your asset value will be showing is down, even if you're cash flowing.
Mhm.
And if you need all of it. So I'm not sure from a municipal standpoint, it makes sense to go out too much longer.
Sounds like all the
I think if
experts
you're
should stick at
Oh,
1 to
I'm-
5.
Stick on the duration, but maybe add some of these
Yeah.
other items.
Mhm.
Yeah,
Well, if we add to the policy, that doesn't mean that they do anything, right? I mean,
but yeah,
I think we can send over a red line of some ideas, get that to Nikki, and get that in front of the committee and ultimately the board.
I want to offer you all a quick compliment. If you look back in your numbers and you see our 5 year number, 5 year number versus benchmark is really strong. And then if you kind of go to page 14, you can kind of dissect why.
right? You can see on 14 in 2000, so I was looking earlier today, talking to Phil, okay, what did they do that was so great? And you can see the treasuries right after COVID in 2020, you guys really loaded up on, not loaded up, but you took a bigger risk on mortgage backs and agency MBS and kept that, and your treasury position went down quite a lot in 2020 and 2021, which is why we're like 40, 50 basis points above benchmark on our 5-year number. So my question was, why is our 5-year number so good? Which means you clearly did well for us in 2020 and 2021, and then the 3-year number is kind of in line with the benchmark. The story is telling me, tell me if I'm wrong, you were looking opportunistically for a place to take risk. And then when there's not opportunistically, we look a little more benchmark-like, and then to the point now where we're a little defensive because there's just less opportunity. Am I stating that right, Brian?
You're nailing it.
I mean, I think visually this tells a pretty interesting story of when you've chosen to take risk in the portfolio and that it has paid off, showing in the numbers.
I mean, when we feel like we're being compensated to take risk, that's when, and again, this is on, I always want to be careful when I say it that way, but ultimately it's always risk return in investing. And even if that risk is relatively marginal, we want to be paid for it. And like I said, right now spreads are pretty tight. Mortgages still look pretty attractive, but corporate spreads are definitely tight. So we've backed off of that area.
Brian. Okay. Thank you, Brian.
Thanks, Brian. So we will switch over to the iPrime portfolio, and Ben's just going to give us a little update on iPrime in those accounts.
So like you said earlier, iPrime is a local government investment pool, or LGIP or LGIP, depending who you ask. I'm an LGIP guy myself. It is allowable only to Illinois municipalities, and what makes it allowable is maintaining a AAA rating from one of the top 3 rating agencies. So we use S&P, and we have maintained a AAA rating since inception in 2019. We have 173 fund participants, all municipalities, of which 71 are cities and villages. We just crossed $2 billion with $2.09 billion under management as of April 30th. So the liquid money market part of the LGIP is called the United Shares Class, ISC, that currently has a 7-day return of 4.29%. So pretty competitive with other money market options in the market. A couple of the other benefits on top of the liquid class is the fixed rate investment platform, allowing the village to buy CDs, treasuries, agencies through iPrime. We also offer no safekeeping, wire transfer, collateralization, or new account fees. So there are no banking fees with iPrime. And on top of the fixed rate and liquid rate platforms, we do a bond proceeds management, which the village takes advantage of, as well as the cash flow analysis program. Just pinpoints high and low watermarks within the fund balances throughout the year to identify any long-term investment potential or potential cash shortfalls. Any questions on what the services that we offer? So we'll flip the page here to the current iPrime portfolios. The top one is going to be the general fund account, which has just over $3.6 million. And that's all liquid in the ISC account, earning the 4.29% 7-day return. The next 4 accounts are going to be bond accounts. We have the 2 2023 issuances, the alternate revenue source, and then the golf course bonds project. Those both have a little over $2.2 million liquid in them. The next one after that is going to be the 2024 series general obligation bonds. That one has a little under $300,000 left in it. So the village has very aggressively spent out those issuance proceeds. And the last one is going to be the 2025 series bonds, which were just issued a few weeks ago. So we have the full $12 million issuance of it.
Exactly. And we'll move on to the next slide, which is kind of the topic of the hour, which is arbitrage. And Nikki did a really nice job in the packet, kind of laying out what arbitrage is, And it's really something that we haven't had to deal with in a very long time. Which I mean, it's a good thing and a bad thing, right? I mean, we always know as GO issuers that there is a bond yield that is assigned to, and it's basically the yield that you're paying on the bonds that you issue. And if the US government does not want you to earn above and beyond that yield because you may be borrowing for profit, right? So as a local government, there are some restrictions on how much you can earn, and but just as IRS has, plenty of different rules for our taxes, they have plenty of different rules related to arbitrage. And the majority of the issues that we see from our local government clients kind of fall under two exceptions, which you'll see on slide 24. The small issuer exception, which if you are borrowing in a calendar year under $5 million, you can earn as much interest as you would like, as long as you stay below that $5 million limit. The other spending exception is the 2-year exception, which for any bond issue that 75% of those proceeds are for construction of a project that would be owned by a government or a nonprofit, as long as you spend those funds based on this spending period schedule. So 10% within 6 months, 45% within 12 months, 75% within 18 months, and 100% within 24 months, you get to keep that interest. The issue that we have with many of our clients, especially with that 2-year exception, when you were borrowing in 2021 and 2022, part of 2022, when rates were extremely low, all of a sudden what you're investing at grows exponentially. So if you weren't able to get those projects done within this 2-year spending schedule, which many were not because materials were still delayed, there was all kinds of reasons for delays in projects during that time that I think we tend to block out of our minds at this point, right? But that's where the bond proceeds management program that we offer helps all of our clients to track each of these issues from the very beginning. So when are your project expenses? How much are you earning throughout the life of that project? And how much may you owe to the IRS when all is said and done? So we've got each of the outstanding bond issues with their calculations included on page 25. I will note that those 2024 bonds do qualify for the small issuer exception. So even though we earned above what that maximum interest allowed is, or that ARB yield of 3.6 and earned 4.9% on that issue, that $22,000 is yours to keep. With the 21 and the 23s, there are some potential liabilities that are out there. The 2021 bonds have been spent out, so those are ready for a third-party calculation. And one of the benefits of the program, we take all of the statements, all of the activity that has happened with the spending of those projects, and send that to a third party, basically someone who all he does is arbitrage calculations. So he knows every detail. I know. He's a very busy man right now. Let's just say that. But he does the calculation and then provides the verification and also helps our clients through that process of making the payments. Each of these outstanding rebate liabilities or potential rebate liabilities, as they're noted, are estimates. We would anticipate that the majority of these are going to have some kind of credit applied when all is said and done. But, to Nikki's point, in the memo, the funds have already been set aside, right? So there's always been kind of that knowledge that there is a potential rebate. As soon as rates started going up, like we could see that there's that mismatch between the bond yield and where we're earning. In the 2025 bond, you know, this is a very, very conservative estimate with right now, we're assuming that rates are going to stay where they currently are. So there's a good chance that there won't be a liability on those 2025 bonds, depending on what happens with the spending there. Any questions about that process, the dollar amounts? I will say that we try and make sure that all of our clients know, like, this is something that you have to go through, but the positive here is that you earned every dollar that you could possibly earn according to the IRS. So we just have to send some back to them. And as long as you have that knowledge that you're sending it back, you're all good.
So unless we can spend it faster, or unless we start floating more small bond issues more frequently instead of the $5 million.
And we're optimistic the golf course, that money is gonna go fast. So I think the exposure there will hopefully be minimal.
Well, and the tricky part about this 2-year exception, which I didn't mention, is once you miss one of those spend downs, you can't go back and make it up. So that's where, you know, if you're not able to, if you borrow the money and you're not able to spend it within the first 6 months, then you're looking at that liability
Right.
potentially.
A lot of just paying the total is less.
25 would be- That's kind of the worst case scenario. What, as Sarah mentioned, one of the things that the gentleman that's going to be doing the calculation for us is going to do is take all of our invoices and make sure that the timing is appropriately allocated there. So these numbers need to change. The initial golf course project that was rough, that once that project got delayed, there was no way we were going to make those targets, so.
Unless there's any questions, then we'll move on to the rest of the agenda. And we've got those notes, so we'll make sure to update for the next portfolio update. But Brian and I can talk through what some of those investment policy changes might look like. Great, thank you very much.
Thank you. Thank you for coming.
Thanks,
Thank you for
everyone.
schlepping. And for the hard work.
Thanks, Brian.
I know.
You still-
Oh, yes, no, no.
Hey, I hung around, yeah.
Brian, thank
Welcome
you.
to stay, Brian, but you really.
You have to.
I'll go now. Bye, everyone.
Thank you.
Really.
We'll just chime in. Thanks, everybody. Nice to meet you. Thank you.
Once you talk about the addition of the word or designee in our policies.
The best is yet to come. Spoiler alert. All right, moving right along, we're gonna head into purchasing policy updates.
So good evening. Tonight I'm going to be reviewing some proposed changes to the village's purchasing policy. Just to remind you, the policy was originally adopted in 2017 and then has been amended periodically since then. Our last update was last year in April. This policy serves as a framework to guide staff in responsible procurement of goods and services. And this policy is designed to ensure due diligence, transparency, and the fulfillment of staff's fiduciary responsibilities to the residents of Glencoe. To remain effective and compliant with evolving standards, the policy is reviewed regularly and updated to reflect changes in legislation, technology, and best practices. In accordance with the village code, the purchasing policy can be amended by resolution. And following our most recent review, staff recommends a series of updates to the policy, and a redline version of the proposed revisions is in your packet this evening. I will review the proposed revisions now. So to start off, language has been added to acknowledge the village's new home rule status. The revision clarifies that provisions of the purchasing policy will govern in cases where they conflict with state statute, except where home rule authority has been expressly granted by the General Assembly. Staff is recommending increasing the village manager's contract approval authority from $25,000 to $35,000. This limit has not been updated since 2017, and since that time, inflation has risen by over 27%. After we reviewed expenditures from March of 19 to April of 2025, raising this limit would have streamlined payments on approximately 80 different purchases, bringing additional efficiencies to our departmental operations. It's important to note that the $25,000 threshold for requiring competitive bids for public works contracts remains unchanged in the proposed policy, in accordance with the Illinois Municipal Code. And the village manager's increased authority cannot extend to waiving bidding requirements for public works projects. The next update would be the internal thresholds governing the departmental purchasing authority have been revised to grant more authority to the department heads or their designees, and to reflect the proposed increase in authority of the village manager. These changes empower department heads or their designees to more efficiently manage routine procurements or reflect current market pricing levels due to inflation. A new section has been added to formally document the village's existing process for waiving competitive bidding requirements. This change is not intended to increase the frequency of waiving bidding, but rather just to document our procedure that's already in place today. We've added new language establishing clear guidelines for suspending or debarring contractors from eligibility for village contracts. It outlines specific causes for such actions, assigns coordination responsibilities to the purchasing coordinator, and requires final ratification by the village manager. While the village has not had to debar a contractor to date, this addition reflects a proactive commitment to best practices. And then minor typographical and formatting updates have been made throughout the policy to improve readability and consistency. That concludes my presentation this evening. And if the committee is comfortable with moving forward with the policy update, it would be considered for approval at the June 19th regular village board meeting. If you have any questions, I'm happy to answer.
I do not. See,
Okay.
straightforward,
Thank
good
you.
presentation,
Yeah,
thank you.
excellent. Margaret, excellent, clear. Good job.
And including the red lines in the packet. Only way any of us are ever gonna pay any real attention in terms of, no, seriously, otherwise we're reading the whole thing.
No, I know, it's
nice,
right?
Yes.
Yeah,
Whereas this way we can focus on what's important,
Yep.
very helpful.
thank you.
Okay, moving right along. Surprise, grocery tax. It's not, shouldn't be a surprise to anyone. So we've discussed this at this committee several times, and also at the February committee of the whole, we had general consensus from the board. We were comfortable moving forward with this. Just a few notes for anyone that's watching at home. Of background, in May of 2024, the state eliminated the 1% grocery tax that was effective January 2026. This was a smart move on their part that did not cut any revenue from their budget, but it affected municipalities statewide to the tune of $325 million. The projected revenue loss for Glencoe would be between 200 and 250,000. From what we can see from the Department of Revenue reports. So as a remedy, the state's proposal and budget included the authority for municipalities to implement a local grocery sales tax. And as a kind gesture on their part, they've agreed not to charge us any collection or administration fees. So on Thursday night's agenda, we have a proposed local ordinance to implement a local grocery tax. This would just be to replace any revenue that's lost. It's not meant for a windfall for us. It's just meant to replace what is being taken away as of January 1st. We will meet our filing deadlines. We missed the April one if we were going to implement for July of this year. Or if we wanted to wait until July 1, but by filing now before October 1st, our local tax would take effect January 1st of 2026. So for the average consumer visiting the grocery store, they should see no difference in their bill. It would be the same as if they were shopping today. We have surveyed municipalities in the area. There's a lot of interest in this topic. We get a lot of surveys from other communities. Everyone wants to know what everyone else is doing. I think a lot of folks were waiting past elections, to have a new board take action on this. So surrounding municipalities that have already adopted, Highland Park, Barrington, Wheeling, Palatine, Hoffman Estates, I believe Highwood has also done it. And then other
And Deerfield has
municipalities.
as well, too.
Deerfield too, okay, so we'll add Deerfield. And then other surrounding municipalities that are considering adoption in the near term, Winnet, Northfield, Gurnee, Northbrook, and Staley have all reached out with their intention to move forward at some point this year. I can answer any questions about the proposal.
If by some, I mean, so our big grocery store, we have a little grocery store, our big grocery store is Rand, which is Sunset. If by some chance, Winnetka and Northbrook are also Grands or Sunsets decided, no, we're not doing it, let us know. Then we would obviously have to think about it, but assuming they're doing it, seems like we have to do it. We need the.
The expectation from what I'm hearing is.
Yeah.
Nobody is waiving
Right.
doing it.
No,
Because they
I
can't.
like I
This
said,
area.
we all need the money, we all
Yeah, the
expect
budget.
this.
Right.
It would just be. It could actually be impactful. If we were the only ones with the same store where it cost, we have this, we actually have the smallest store.
Highland Park has implemented.
They've
it
done it,
already.
right, so they've done it already. This is obviously the right thing to do now, let us know if something changes.
I make a statement. I think it's important to tell our citizens, this is not a new tax. It's-
Yes.
Yeah, it's actually been a pretty heavily covered set of discussions around the region. It's on the news virtually every night when there's a new community that has kind of put it back in place. So it is, the good thing about that is that it's a story that's easily repeated from the standpoint of what other communities have done. So that would be something we would absolutely do as well.
And the other benefit of doing this sooner rather than later is that we're hearing from Northwest Municipal Conference, from the Illinois Municipal League, that part of the opposition to the state of Illinois doing this was, this is going to hurt the municipalities, so you have to give them a remedy. And what the concern is, as our legislators continue to legislate this year, if municipalities don't implement the remedies they were given, the state is going to take the position that that money's not needed and that they may continue to take. So the Illinois Municipal League, the Northwest Municipal Conference have strongly encouraged municipalities to adopt this sooner rather than later, before legislative session is over. So that they can use that as a negotiating tactic and for any other items that may come across the board of additional monies that may be taken from municipalities. So we will, if this is approved by the village board on Thursday night, we will file it with the Department of Revenue right away for that reason.
Very good. Thank you.
Grocery tax.
Would anyone like to talk about anything else? I'd say tariffs, but whatever we talk about will be old news
Sure what they are.
by tomorrow morning.
Well, they're gonna stay higher, and slightly, if anything, but
They are slightly
I guess. Even if whatever we saw today happens,
We're still way high.
Oh, yeah, compared to how they were.
well, they're higher, definitely, if they keep the fentanyl. Not thing on the fentanyl tax on China, they're gonna stay higher, but I guess what I was thinking specifically is the golf course, I guess to Stella, like. Is there any indication again of any kind of? Are they coming back to us saying, oh, I've got X, Y, Z? That's awesome.
All righty. There is nothing else, then we have a motion to adjourn, please.
Second.
All those in favor?
Aye.
Aye, we are adjourned.
Thanks, everybody.
God, we got all that
Congratulations to
in.
you and your daughter.